The market is up 4% in January, a great start to the year, but is this the biggest bull trap so far that we've had in a year? If we take a look at this chart, you can see that the market structure isn't broken yet. And I promise you, by the end of this video, even though we can't predict the future, you will have better clarity on whether this is a potential bull trap or not, how we should be trading this. And I'm going to be diving into the economic data and what is upcoming that is going to be the driver of what happens in the market from here on out. Let's get right into it. All right, before we get started, I just want to say go ahead and follow me on Twitter and Instagram, where I post daily free trading and finance content, and I give a lot of signals and analysis out there as well. It's worth the follow. It's free. Check the Linktree app in the description for the socials. So it's no secret that the market right now is at a major trend line. If you follow anybody who does macro analysis online, you will probably have already seen this trend line here. This is the weekly chart on the S&P 500. And once again, we are right at the pivotal trend line. Now, it's important to note that market structure has not been broken yet. And don't worry if you are a newbie to charting. I will show you very quickly, easily how I know that. So we had the highs in January. We made a lower low, lower high, lower low, lower high, lower low, lower high. And now if this breaks this previous high, then we will have a brand new market structure. Another easy way to do this is to change this from candles to lines, and you can see where the peaks are. And a new market structure is formed when a previous major peak is broken. Now, you might be asking to yourself, is this shortable here? Just like this was, just like this was. And for those of you that are fans of this channel, you know we've been shorting this trend line all along. I have a Robinhood account that I use just for shorting. And if you see here from December 14th until now, this account is up 73%. And that coincides with this candle right here that we had on the week of December 12th, where we had an epic rejection from this trend line. And if you want to learn how to short, how to trade futures, if you want to learn how to trade options, you want access to the options course, the day trading course, the chat with thousands of traders where we go over these strategies every day. So you're not left just looking at your portfolio, seeing it dwindle away for an entire year without knowing what to do about it. That link is in the description. We are also doing a free webinar for all to join. There will be limited spots because of Zoom. That link is also in the description. We're doing that on January 28th at 12 p.m. Eastern. It's a Saturday. It's the same mastermind calls that we go over regularly with the Traveling Trader Academy. We go over topics such as futures trading, risk to reward ratios, how to pick option expirations and strike prices, TA, technical analysis, etc. So if you want to join, make sure you click that link in the description and reserve your spot because seats will be limited. All right, back to the charts. So you could actually short from here, and because the trend is still valid, you could definitely short from here for an optimal play. Obviously, nothing is guaranteed, and this trend will eventually be broken. So let's talk about some other things that are going on where this trend could actually be broken and we could actually see a bull rally. Because remember, even in bear markets, you can have bull rallies. There is this sentiment or this notion that you are either a bear or a bull, but we've had tons of bull rallies within epic bear markets. So let's talk about this. So if we look at the VIX here, right? And the VIX is the volatility index. This is derived from how institutions are betting using S&P 500 futures. And right now we are at a critical level. So I want you to look at something, and this is not magic. If we take a line on the VIX and draw a trend line at the bottom going all the way back to January 2022, where the top of the bull market ended, right here on the S&P 500. Look at what happens every time we reject off of this trend line here with an epic rejection, the same exact trend line. The VIX makes a low, and we are at that level again. So not only has the S&P 500 hit this major trend line, but the VIX actually has hit its trend line as well. When the VIX is low like this is actually not a comfortable time for seasoned investors. Seasoned investors like to buy when the VIX is high. And again, if you guys familiar with the Academy know that the last buys we made were in October when the VIX was at around 35 and the S&P 500 made new lows. Would I buy stocks here? No, I would. If you have not already bought stocks, this is not the area that I would buy stocks. Let's take a look at more data points. Let's look at the put call ratio. This is the CBOE equity put call ratio, the total put call ratio for all equities on the CBOE. You can see that right now we are at 0.69. This is right in range with the lows for this market. Once we get into the 50s and 60s, this coincides with a low VIX and a market that is topping out. So in general, you want to also be investing not only when the VIX is high, when the market makes a new low or matches a new low, but when the put call ratio is high, preferably above 1, that is another data point that provides confluence. When the VIX is when the VIX is high, when the market makes a new low or matches a previous low, major low, and when the CBOE put call ratio is high at above 1, preferably. Now, you guys know that I don't really care for the fear and greed index as an isolated indicator, but if we take a look at the timeline, look at the fear and greed index now. We are, for this market, historically high. And by high, I mean high on the greed measure. The last time we hit a high on this greed level, look at this. It was back in mid-November, August, and back in April. Let's take a look at what happened there. Here's mid-November, here's August, and here is beginning of April. So this is definitely not when you want to invest. Again, I'm not Nostradamus. I'm not saying we won't break through here, and we will look at the bullish case where we could actually break through here and create a bull run within this bear market. I will give you that scenario to allow us to know how to trade this or potentially pivot if we are in a bearish trade. But based on this, all these indicators, right, so far, where the S&P is at this trend line, where the VIX is, where the CBOE put call ratio is, and where the fear and greed index is historically. We are also seeing a resurgence in risk on assets as Bitcoin rallies 25% from its lows. Bitcoin is one of the most risk on assets and really an indication that the market right now is in a risk on sentiment, right? But obviously risk on, risk off doesn't really have a timeline. The market can be risk on for a month. It's not like there is a need for these things to be long standing. And I want you to take a look at this. Bitcoin is not separated from the stock market. Every time the stock market is risk on and that greed indicator is high, Bitcoin does tend to also top out, right? Like the last time we saw Bitcoin at above 20,000 was, not surprisingly, right around this time here. And then you look at the beginning of April, lines up with here. You look at August, lines up with the last time Bitcoin was at around 25,000. So this stuff is so far in line with an epic bear trap so far. Now, with each of these rallies, there was a narrative, whether it was earnings, whether it was better than expected inflation, whether it was comments from the Fed chair, dovish comments from the Fed chair. In this case, right now, the narrative is, oh, inflation is going down. Let's forget about inflation. Now let's face towards earnings, which for the stock market, we're getting major earnings at the end of January, beginning of February. That's when all the mega caps report. We did just have mixed earnings from the banks, but the mega caps will all report by the end of January, beginning of February. So the narrative now is that inflation is dropping for a 6th straight month. And I'm going to look into the actual inflation categories in a second. But, the market likes to hype up these storylines, even if there's no truth to them. So if we take a look at the Fed meeting minutes from the December meeting, none of the 19 policymakers foresee any rate cuts this year in 2023. However, if you take a look at the Fed funds futures curve, you will see that market participants and institutions are betting that the Fed starts cutting rates by the second half of this year, with rate cuts in September and also in December of 2023. If we take a look at the Bloomberg data, you'll see the same, that rates will peak in the first half of 2023 and start to cut throughout the rest of 2023 into 2024. Now, before I get into the bull case for the S&P 500, how we could see an epic bull rally from here, I just want to talk a little bit about the inflation data, because I do think that narrative is being undersold a bit, right? Yes, inflation, if we look at the CPI, is down for the 6th straight month. However, even anecdotally, Anecdotally, those of you that have been to the grocery store know that you're still paying $8, $9, $10 for eggs, which is basically a meme at this point. However, let's take a look at each of these categories. So month over month, airline fares are down. Car repairs are up, almost up 20% year over year. Delivery services up over 13% year over year. Milk is down month over month, but year over year, still 12.5%. Groceries are actually up, not surprisingly, month over month. That didn't go down. Almost 12% year over year. Restaurants are up. Rent is up, right? 0.8% month over month. Not surprising for those of you that are renting. 8.3% year over year. Gas, which has been probably the biggest contributor to inflation going down month over month, is down almost 10% month over month. But that's because we started at insane gas prices where some states have seen $7 a gallon. And then used cars, obviously, down almost 9% month over month, or year over year, sorry, 2.5% month over month. So this, gas and used cars have really been the driver of inflation going down. Everything else that's important, rent, groceries. So I don't think the inflation story is quite over yet. And I do think that the Fed is going to raise rates on February 1st. Now, here's the bull case for the S&P 500, where we could break this year-long trend line and actually bull rally to around 4,300. I'm not saying that's going to happen. I'm saying if what I'm about to say occurs, then I do think that we can get to 4,300, which would match the highs from August and be at the golden pocket on the Fibonacci, right? Here's what needs to happen. Earnings come in higher than expected. Everyone is expecting grim earnings because of where rates are at. However, let's take a look at the GDP. Currently, the the Atlanta Fed tracker is showing that Q4 GDP 4.1%. That is historically high. That would be one of the best GDPs that this country has seen, especially when we are nearing a recession, right? 4.1% growth for Q4. Obviously, unemployment is still historically low, the lowest unemployment since 1969 at 3.5%. So there is a chance that this next round of earnings actually does not come out as terrible as was once projected. And that would essentially allow us, I think, to break this trend line here. Also, the Fed meeting is on February 1st. And if the Fed actually sounds dovish, I do think they will raise. I'm on record as saying that they will raise by 25 basis points. I actually have a bet with the Traveling Trader Academy, the community, that if they don't raise rates by 25 basis points, if it's something else, I will buy somebody a brand new trading monitor. I will pick someone at random and buy them a brand new trading monitor. But we do, from a pattern perspective, have this inverse head and shoulders, which could play out if earnings are good, if the Fed sounds dovish on February 1st, raising rates, but saying, guess what? We have a definitive date on pausing. We're going to raise rates by 25 bips on February 1st, 25 bips in March, and then we're pausing and we're going to hold rates for the rest of the year, or we're going to hold rates and see what happens. For sure, we will get a bull rally, in my view. I don't think that good earnings and a dovish Fed can crash the market. I just don't think that can happen. Now, obviously, I'm recording this January 16th, January 17th. And we do have quite a bit of time from then until February 1st, where we could see a rejection from here. But if earnings come out positive, if the Fed comes out dovish, I do think that we could see a bull rally to maybe between 4,150 to 4,300 on the S&P 500. Historically, the Fed doesn't cut rates until we're in a recession. All of the yield curves are pointing to a potential recession, and we have not yet seen what a 5% or near 5% Fed funds rate is. We have not yet seen that reflected in the economy, right? Because unemployment is still historically low and the GDP is actually going the other way, growing at a record clip. So like I said, I do think you can actually short from this trend line. I wouldn't hold that short too long. I'm not as confident as, for instance, this short here or the short back in August, because of the Fed funds meeting, or the FOMC meeting on February 1st and the earnings. Like if I did short, it would probably be open for only 2 weeks. I'm not going to be holding this short for a long time. But again, check the Academy if you want all of my plays. So there you have it. In summary, this so far all points to an epic bull trap, right? This is an epic bull trap based on all of the indicators that we looked at. But unfortunately, it's not going to be a definitive play, as definitive as the other times that we've tested this trend line, because of the fact that we have earnings and the Fed meeting, where the Fed can easily come out and say, we're going to raise this time, raise in March, pause. If they do say that, I think the market will rally momentarily. Now, in the midterm, I do think that a 5% interest rate will have a deleterious effect on the economy, and we will start to see it affect earnings and unemployment. And once that stuff takes a hit, then I think that the Fed will, towards the end of the year, look at potentially cutting, depending on the extent of those effects. They may not cut until 2024, but I do think that later this year, we will finally start to see what a 5% interest rate looks like, or 5% Fed funds rate looks like. And we will start to see that reflected in different pockets of the economy, unfortunately, and be near recession territory, right? Whether the Fed cuts end of this year or cuts next year is really going to be determined by the extent of those effects. And unfortunately, nobody knows, right? But anyway, traders, hope you got something out of this video. Again, join the free webinar January 28th, open to everybody at 12 p.m. Eastern. Check the link in the description. Please reserve a spot. And if you do reserve a spot, please show up so that you're not just taking up a spot emptily. And if you want access to all of my trades, my analysis, etc., link is in the description below. Join the Traveling Trader Academy. It is worth your while, I promise. Leave a comment down below. Let me know what you think, if this is an epic bull trap or not. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.